पास बिल्डिंग है, प्रॉपर्टी है, बैंक बैलेंस है, नौकर चाकर है, तुम्हारे पास क्या है?
मेरे पास वक्त है. हाय.
अरे तू शशि कपूर होतास ना?
अरे दिस इज दीवार 2.0.
Oh. Hey folks, here Rachana Ranade here and I welcome you all to another brand new lecture which is on how to start investing in your 20s. If you are in your 20s, I'm sure you might have just finished your education or you might have just started earning. So this is a very important phase of your life when it comes to starting investing early. So if you want to know about all these basics, let's begin right away. Let's understand the top 3 reasons why you should start investing early. So the very first reason, if you remember, I said, mere paas waqt hai. So if someone starts investing at the age of 21 or 22, you can imagine that that person will be investing from this age till the age of 60 almost. So you can imagine what a big corpus that person will have for his retirement purpose, right? Number 1. Number 2 is that because you start early, you have the benefit of risk averaging. Now you will be like, what is this risk averaging? Just have a look at this nifty chart. Now I'll give you a practical example. I qualified as a chartered accountant in the year 2008. Have a look at that chart in 2008. So that's where I started investing. And as usual, as a new investor starts investing, immediately there's a market fall. Everyone knows what happened in 2008. Now you can imagine, had I stopped investing because the market asas asta, okay, whenever I start investing, it will go down and all that. That would have been a big negative point for me. What I did, I kept on that discipline of investing at regular intervals. So what might have happened? I invested in 2008, I invested in 2009, 10, and now you can see at 11, already it has come back to the level of 2008. Again, I kept on investing 12, 13, 14, 15, 20. I'm investing till date, and now you can compare the level of 2008 with the level of 2020. It has majorly increased since then. So can I say, because I invested in a disciplined way, because I invested at every specific time interval, my risk was automatically averaged out. So I hope you have understood this point of risk averaging. And the last important point is that you can have a very nice compounding effect if you start investing early. But how is what we are going to check out immediately. Let's understand how an amazing effect of compounding can be seen if you start investing early. Okay, so we have to give some basic inputs. Inputs like what? You have to give your input of your current age. You have to give an input of what will be your retirement age, right? Third thing, you have to give an input of how much will be your monthly investment amount. Okay, generally we talk about investing very systematically like a SIP, systematic investment plan, right? And number 4 input that you have to give is how much returns do you expect. Okay, let's say we are going to take a return of 10%, which is not very high if I'm going to talk about a longer time frame. So shall we start inputting the data? Yes. Okay, chalo, the very first one is current age. What is your current age? Kai? 21. Chalo, theek hai, 21. Okay, at what time do you want to retire? Now I will tell you. 60. Okay, assume 60. How much are you going to invest monthly? Minimum target I am going to give you 10,000 rupees monthly. You have to invest. Okay, let's assume that you are going to get a 10% return over how much time frame? 39 years. That's a longer time frame. If you do this systematically over a period of 39 years, every single month without missing even one month, you are going to get an amazing return. And your final amount is going to be 5 crore 76 lakhs 8,714. Amazing. Just by investing 10k per month, you're going to get that 5 crore plus amount. Now understand how compounding works. Mere paas waqt hai. How does that work? If you start investing at the age of 40, that amount is going to be just 76 lakhs. Okay, I hope you have understood how big a difference can be created if you start investing early and if you have that financial discipline in you. Now let's understand the top 3 things that young investors should avoid while investing. The very first one is to follow the advice of your friends Tipendra. Okay, because that person is just going to give you hot tips and you're going to just blindly rely on him. So don't do that. Don't invest based on Tipendra. Number 2 mistake which many people do is that Exactly. That's what they do. They invest in the market without having proper knowledge. So if you do that, again, you're going to fall flat on your face and you're going to make losses. Don't do that. And number three is that please don't follow the herd mentality. There are going to be many people who are going to just invest because their friends are investing, and their friends are investing because their friends are investing, and none of them knows why they are investing. So avoid the herd mentality. Now let's try and understand where can you invest your money. I'm sure everyone knows that there are two major options. One is equity and the other one is debt. Okay. Now question is, how much should you invest in equity? There is a very standard thumb rule which says that 100 minus your age should be your percentage investment in equity. My maths is not that good, so assume that my age is 25. Okay. So in this case, how much will be investment in equity? It will be 100 minus 25. So 75% of my investment should go in equity and 25% should go in debt. Now the next question arises is that if I were to invest in equity, how and where can I invest in equity? That depends on certain factors. There are various possibilities. Possibility number one is that you invest directly in equities. Okay, when can you explore this? You can explore this if you have knowledge, or possibility number two, you're prepared to gain that much knowledge by maybe watching a lot of YouTube videos or checking out my various courses on my website rachanaranade.com, or whatever, reading books as well, right? So that you can do when you have knowledge in stock market or you're ready to gain knowledge in stock market. Possibility number two, you're not sure about a specific stock, but you're sure about a specific theme. We are going to talk about this in the immediate next part of the video, right? And possibility number three is that you're neither sure about a specific stock, nor are you sure about a specific theme, but you are sure about the overall direction in the market. So you remember that Nifty ka chart from 2008 to 2020, it has gone in the upward direction. So you feel that all in all it will go up, so I want to invest directly in Nifty. Can you do that? Answer is yes, by investing in Nifty Bs. For that I have a separate video on how and what are Bs, what are the different types. So whenever time permits, you can check out that video as well. So now let's understand how can we invest in a specific theme. Theme of investing with a small amount and theme of investing in top 100 companies. Top 100 based on what? Top 100 based on their market capitalization. For that we have a top 100 small case which invests in Nippon India Nifty 50 Bs ETF and Nippon India Junior Bs ETF. The weightage is also very clearly given, 32.98% and 67.01% respectively. Now, if you check the overview as well, this small case has clearly outperformed the equity large cap. We also need to check what is the minimum investment amount. It's just 554 rupees. What is the CAGR? CAGR is 16.91%. So I think both are purposes of investing in top 100 companies by market capitalization with a small amount of just 554 rupees is very well suited in this small case. So if you want to start your investment journey, just check out the link in the description box. Also, if you want to have a little bit of higher risk, there is one more small case which is known as the value and momentum small case. You can also check out the link in description for that. But again, be aware that second small case is only for those who are ready to take a shade higher risk. Let's understand how can you start investing in debt. Now there are two options that we are going to discuss primarily today. One is investing in PPF. The other one is investing in alternate funds like what? Something like a gold fund or something like a debt fund. But first, let's start with PPF. Very first and foremost point that you should know about PPF is that it has a lock-in period of 15 years. Why am I talking about this? 15 years, if you start early, you will be comfortable at a very young age. Means what? I started investing in PPF when I was 21. And in the next year, if I'm talking about current scenario, in the next year, I would have completed my 15 years. Okay, so calculate my age, that's a homework. But anyways, next year, I would have completed 15 years. So my major lock-in is over now. Can I extend my PPF? Yes, now extension happens only for 5 years. So my lock-in is drastically reduced now. So I hope you have understood the importance of starting your PPF at a very young age. With how much amount can I start investing? Only with 500 rupees, you can start your investment journey in PPF. You can invest 500 rupees every month. That is allowed. What is the maximum limit? Maximum limit is 1,50,000 rupees. Whatever interest you're going to get is going to be absolutely tax-free, and the interest rate currently is 7.1%, right? Also, you get a benefit under Section 80C of the Income Tax Act, when you invest in PPF, right? Now let's move on with the second point that we are going to talk about, investing in gold fund or investing in a debt fund. If you invest in gold, we typically say that gold acts as a very good hedge against the market volatility. It's always said that equity and gold move in the opposite direction. Okay, so that's why I'm saying that investing in gold makes sense as a good hedging parameter. Second one is a basic thumb rule wherein we say that never put all your eggs in one basket. So even if PPF is good, don't invest entirely in PPF. Invest some in PPF, some in gold, some in debt. That will give you a good overall balancing. Number three, if you're investing in gold or in debt, there is a chance that you may earn a shade higher than 7.1%, right? So I hope you have understood that even if I'm talking about investment in debt, there are various options available in the market. Now let's understand how can a portfolio allocation be done. Is this the only way wherein the portfolio allocation can be done? No, this is just an example that I'm telling you. Now if you observe very carefully, I've done two major parts. The left one, which talks about 75%, that is investing in equity. Right one talks about investing in debt. Now if you check out debt, I have given 25% equal allocation to PPF and to gold or debt funds. Okay, can that percentage vary from investor to investor? It can. I've given this as an example. If you go to that 75% category, now there I've given different splits based on what? Based on the investor's profile. Three category of investor profile: low risk, moderate risk, and high risk. Here you can see that a person who has low risk, I've given 0% for stock SIPs directly into stock market. And if you see the high risk category person, you can see that 45% allocation can be given in direct in equity investing. So all in all, I hope you have understood how based on risk profile, your equity exposure, the way in which you invest in equity can change from person to person. If you want me to make a separate video on how to calculate risk, please let me know in the comment section. I'll make a separate video for you. Well, is there any small case which talks about investing in equity, in debt, as well as in gold, all at the same point in time? Answer is yes. The name of that small case is all weather investing. Of course, again, link is there in the description. This small case has given a CAGR of almost 13.63%. Well, I hope you have enjoyed this video, and if you have, don't forget to share it with your friends. Even if you're not in your 20s, even if you're there in your 40s or 50s, you can share it with your neighbors, with your relatives, and help me spread financial literacy and financial awareness amongst everyone. Till then, take care, Jai Hind, and bye-bye.